All right. What is up?
What up?
What up?
Welcome back. We got the energy back today. That was the
Ryan
best intro
actually
we've
said
had in a
something.
while.
Yeah.
Wow. Properly
Go,
caffeinated.
let's do it.
Monster, sponsor us, please.
Well, you know, OSU scored more than 3
Yeah.
points last week, so Brian is like back and
We
motivated.
scored like 14 points. Man, we are back.
I think they actually,
Back, baby.
I got to give them some credit. They did show up.
Yeah,
They did. They showed up.
well, they got some.
Made the
They
game
probably
out
got
of
a hell of a motivating speech from the interim coach.
Yeah.
Like that was a wild run, boys. It's over now. Pain is over.
He's like, this is the first game as head coach. Please don't let me get fired after one.
It's just going to get worse. You know, if your coach gets fired within the first 4 games or something, they reopen the portal and all your players can leave.
No.
Yeah, and that's what's going on right now.
Oh
You
my
guys
God.
had to figure that out the hard way.
Yeah. Anyway, I'm not sure what the exact rule is, but all right.
Well,
What kind of updates we have for Criterion? What great things?
One big update that's coming pretty soon is it is motherfucking distribution time.
it is. It is. This is the best time of the year. Happens 4 times a year.
We'll give you exact updates next week on how much we're sending out to the investors.
I don't know why you're asking. We had an investor email us today asking where his distributions were. Come on.
Dude, I'm telling you, January 2nd, where's my K1? That's you. Stop it.
If you
If that's you,
if you
Dan
would like to be
Alabac.
an investor and you like your K1s before tax day, please do not apply. We don't want your money.
Whew, and we're back. Okay.
We'll take your money.
So, we are closing on the Payway building. We built this building. We started the process building the building. We bought the land 3 years ago. The buildings are complete. We sold the Salad and Go. So final sale. It's distribution time on that asset. We're going to ship out like $1.8 million, I think,
Nice.
including the original equity.
Wow.
But I think it's going to shape up to be a low 30s total profit. So 1.3 to a 1.35 equity multiple. It took us about 3 years. Tons of things went wrong in that, and we still escaped with a
profit.
good return.
Yeah, with profit.
A good return.
Was that the very first development partnership?
I mean, we did the Kitty Academies.
Kitty Academies, yeah.
Okay. Well, that was with
not including-
Woodmont, but that was the first time that
This is the first multi-tenant one.
yeah.
Yeah.
So, yeah, I mean, when things go wrong, it takes longer. That's why development is inherently riskier because you just don't have as much control over all the factors. But we ended up, we got it done, and the investors are getting their money back plus profit. And we learned a lot, and we're applying everything we learned to new developments that we're doing today to help control that process and to make sure that future projects don't get delayed like that. So,
But still, I mean, escaping with, I think we can talk about the IRR. It's gonna be like 10.5, 11 IRR. So 1.35 equity multiple is in over 3 years, right? But a classic case of like, hey, a lot of things went wrong in this deal. Downside 11%.
Yeah.
That's great.
yeah,
Right.
I think it was good.
And that makes the times where we hit the 30 and the 40 like that, it's just the volatility. If you don't like the volatility in returns like that, I wouldn't do the development deals. We're really good at underwriting the neighborhood and community retail shopping centers, and we get damn close on those returns. Very, very, very close. They're just predictable.
Yeah, this 10% will offset the 86% we got on El Luchador a little bit.
Yeah, for sure. We're still talking about
Gonna
that.
bring it down.
Okay, other updates. If you are on our newsletter, which just time out. If you're this far on the podcast and you haven't signed up to the investor list, you should do that now, right? Because the newsletter went out yesterday, right?
It did. Yep.
Team spends a ton of time on that. By the team, I mean Andy, Beth, Jackson.
All of us.
Yeah, Brian's the in-house grammar Nazi, in case you didn't know.
Yeah. But it's free information. So if you're watching the podcast and you're interested in commercial real estate, why not get the newsletter and get market insights, market updates, all project updates on what we're working on.
All project updates, yeah.
You'll get familiar with what we're doing, some of the highs, some of the lows, some of the challenges, and some of the the benefits. And so you got to get it, and it's free.
Yeah, and the quarterly reports coming out from Appfolio will typically come out almost a month from now, like at the end of October. So the newsletter is, you're getting the information way faster.
Yeah.
You know, if you want information on that asset as soon as possible, the newsletter is your place to get it.
Yeah, I see a lot of people asking us for updates when if they'd read the newsletter, they'd have the latest.
Yeah.
Right.
Way to shame all of our investors. Great. Good job.
Just the dumb ones.
Do not ask us for an update.
Other updates. Oh, today we're going non-refundable on Gateway. Yes. That amendment is in my email to sign. I'm going to sign it as soon as we get done filming this podcast. We're freaking buying it.
Do you have to sign that before 5 or anything?
Yeah, I got time. I
got a few minutes.
I got time.
Loan approval, got that today. So we are loan committed.
From MidFirst Bank, guys.
Yeah, shout out.
MidFirst Bank. They are awesome.
Here in Tulsa.
They're awesome. Mabry's still my favorite. I'm allowed to say that.
Stride, great. We love it.
Great. We love them. But MidFirst, hey.
But if you want us to love your bank the most, I mean, we do have ad space available.
Yeah.
On the podcast. So
yeah, and we like money.
You can earn our love.
pay for it.
Okay, what other updates? Anything else? Thunder preseason.
I made a crypto prediction last week. 2 notes. First, that was not financial advice.
But it was 6 months down the road. So.
And second, it's up 10% this last week. So I'm on the way to being a prognosticator.
What's up 10%?
Bitcoin and most altcoins.
Okay.
Yeah. Okay.
You got a ways to go.
Hey, but we got a great show today, and I'm trying to help a friend that wants to get into commercial real estate, and questions come up, and the question was, okay, we think we found a deal that he likes. What are all the costs that he's got to consider when buying that deal? Because you got your down payment. Let's say it's 25%. You're buying a $5 million deal or a $4 million deal. You need $1 million of equity, but that isn't all you need. And so I was trying to kind of conceptualize, hey, there's 50 other fees that you need to plan for. And so it just got me thinking about a podcast is we got to prepare you guys on what the costs are in getting a deal closed. And so we brought some closing statements here today, and we thought we would just try to educate a little bit on all the stuff that's going to hit that closing statement when you're buying a commercial real estate deal.
If you've ever bought a house, you know the feeling. Mm-hmm. You know the feeling.
Just take it times 100.
Mm-hmm.
All right.
Let's go through it.
We got a couple deals here. One in Texas.
Yeah.
We got one in Texas and another one in Michigan.
Yep. So we got the closing statements here, and we're just going to kind of roll through some of the expenses, and then at the end, we'll kind of talk about percentages and how to ballpark these in just one lump sum when you're trying to plan your equity raise.
All right. That sounds good. Where are we starting?
Well, we'll start with loan charges. A lot of times lenders will try to get you to pay a point origination. And if the lender isn't charging it, if you go through a mortgage broker, they're going to try to charge you a full point, 1% of the loan amount.
Robbery.
It is. I mean, it really is something you don't have to pay. That's just profit for the bank. And so if you say, hey, we don't pay origination charges, or we don't pay more than a 1/4 point origination, and that's kind of what we do. You say, hey, we'll let you have a token fee, but that's it, because there's just too many banks competing for our business. But this is going to be valuable, because if you're a beginner and you are going to a lender, they're gonna say they have to have it, and you're gonna believe them.
Yeah.
But so we budget a 1/4 point origination.
Okay.
And then you've got
guys. You're borrowing millions of dollars. It's a negotiation, right? There's no rule book for loaning $4 million. Ask for what you want, guys, especially the first time. Ask a lot of questions.
All right, next on this, we've got the appraisal. Usually the lender has to order that, and that's typically $3,000 to $5,000. In this case, it was $4,000.
The lender does have to order that. The good news is when you're quoting it out, the lenders can typically assign them to each other. So we kind of pick our lead candidate. We have them order the appraisal. If something were to happen, they can assign that over to a new bank.
And the banks are more than willing to do that, right? We've never had a problem with that.
Yeah. The other thing is banks can quote out the appraisal cost and timeline, right? Both are important factors. Sometimes you need a really quick appraisal, and you can get that done for a little bit of an extra fee. A lot of times you can have it expedited for an extra $1,000 if you need to. So again, there's some wiggle room there.
Yeah.
Next one's super important, $17 to flood certification fee. Mm-hmm. And I noticed on this other deal where Mabry was a lender, they only charged us $16 for this flood. I mean, getting ripped off on that.
That's why he likes Mabry better.
Yeah,
They
they're
saved us
$1 cheaper.
Got our back.
Well, not only do you have to order the appraisal, but you got to pay the bank to review the appraisal. That's $250.
Yeah.
Well, because they don't do it, they hire somebody else to review it. Like nobody, they're not doing anything, right? They're paying
literally
some other expert.
Well, they're pulling up the appraisal and they're saying, "Does that value right there? Is that equal to purchase price right here? I want to charge $250." Like literally, that's what they're doing. There's nothing else is going on right there. All right, moving on. Title and escrow charges. Man, you can get hammered on title insurance and specific coverages the lender likes to get on the title. So here I'll just name a few of these. First of all, you got the recording fee, $9.60. Really interesting how they needed that 60 cents. Escrow fee, that's just the fee to the title company to handle your side of the transaction. That's $650.
And guys, that can be arranged too. I've seen $1,000, $1,500. If you start to see thousands of dollars for a closing, then you're getting screwed, right?
Yeah, we used to do them here in Oklahoma, and there was like, it may not be that today, but in years past, $300, $350 for each side on the closing fee. This one's double that.
I think she finally raised her prices. I said something to her, and she's $500.
Okay, I mean it's reasonable.
It's a deal. It's too cheap. Raise your prices.
So lender's title insurance, $100. Title fee, $2. Not yet due and payable tax, $5. All this stuff they just shove on there, because they can. Here's the thing, is you are going to get to the closing table and you've got deadlines and you've got a contract that says you have to close by this date, and all this stuff just gets thrown on the closing statement, and you can't hold up, or you don't want to hold up a multi-million-dollar closing over these fees. And so they end up just getting paid. And I think everybody knows that. That's why they just throw them on there. All right. Title,
What's the restrictions, encroachments, and mineral endorsement, just to make sure there's no problems there? I mean, I don't
clean
know.
title, bro. The headaches we have to go through to get clean title. And then not only that, but just think of how long we've been recording proof of ownership on land in the United States. It's hundreds of years now. So there's so much shit on title clouding it up, and we are very thorough, and we have our attorneys engaged to go through and file the proper paperwork to abandon shit that's not on there anymore, and just make sure that we have it documented on the survey, and the survey lists all of the title exceptions and any easements and encroachments, because you do have some exposure there. You want to make sure your recorded ownership and understand what you're buying very, very clearly.
Yeah.
Like, does somebody have an easement? Are they allowed to park here? Who's allowed to pay for everything? All of that is very recorded, even more so in big box space. I think we kind of get out of a lot of it in the neighborhood and community space, but like the fluorescent deal, all the stuff that Target has recorded, like when you get a big anchor or a grocer like that, they record all sorts of stuff to just make sure those agreements that they had actually uphold. And that's really the only way to do it, is to record it at a courthouse and get it listed on the title.
So that we had the $1,400, and then this is all under the title endorsement and title insurance. $100, $20, $1,791, $50, $100, an access endorsement, survey review, $2,700.
I had a 2-hour argument the other day with the closing company and their attorney, because they tried to tell us that we couldn't give an easement on our own property to another property without it being reciprocal, without having that like mortgagee of the tenant sign. Oh, yeah. And I'm like, I own the property. I can declare an easement. It does not have to be reciprocal. They do not have to sign it as the mortgage holder. Yeah. Like, it's an easement on my property. I'm allowed to give it. And they ended up allowing us to do it, but it was this massive headache to get to closing, because again, the thing we were selling this Applebee's kind of in the middle of our shopping center, and they brought it up when they were looking and doing the same process. They were like, guys, we don't have a legal access to our site. Like, there's no recorded legal easement or access allowing our customers to get in, to the Applebee's, because it's in the middle of our parking lot. So technically we could say, hey, your customers are not allowed to drive on our property, and then shut down their business. So it's examples like that you can think of where all of those access rights and parking rights and what your building looks like and who pays for everything, all of that's recorded on the title company. And you can imagine if you find a piece of land that was developed 100 years ago, there's a lot of just crazy stuff on there, and it gets messy.
Okay, let's see. The recording fee, $115. Then we've got the property condition report and the survey. On this deal, they were combined about $8,200. And then we've got the Criterion invoice. And so what we got there is you've got, let's see, the cost to do the pitch deck for the investors, right? That really nice brochure with all that. That's a couple grand probably. Then you've got
These are our pursuit costs.
Yeah. Then we've got travel to the site for us to look at it. We that's part of the closing fee that we charge. The syndication documents, our legal expense. We have an attorney reviewing all these documents for us, right? That's all in this cost. And on this deal, it was $8,368. And so just to give you a ballpark, the total of all of these fees on this deal was $42,750, which came out to about 1.1% of the purchase price. All the fees that we talked about just now. Okay. All right, so we'll look at one more, and then we'll kind of sum it up.
We can probably go through this one a little faster, especially on the title stuff. Yeah.
Yeah, we'll go through pretty quick. So on this one, we have very similar loan charges that we talked about last time. We've got very similar title insurance charges, but the title there wasn't as much junk on this title, and so the title charges were less overall. Mm-hmm. The closing fee on this one is not $650, but $800. So you can see the difference. Wow. They charged $100 a quarter recording fee, and they charged $25 to mail documents. Mm-hmm. So once again, they're just trying to stick fees on here for you. Let's see. The property condition report and the survey were $81 versus $8,200, about the same. Let's see.
That includes phase one as well. Yeah. Phase one environmental.
Yeah.
We had a lot higher pursuit cost on this one because it's out of state. And so we had plane tickets and hotels and meals. But the total on this one was $54,000, and that equaled just under 1% of the purchase price.
Which makes sense. The bigger the property, the less the costs get a little bit.
That's right. I mean, the appraisal, the property condition report, the survey, these kind of things aren't really going to change on a $3 million shopping center and an $8 million shopping center.
Same thing with the attorney's time. It's really about the same.
Yeah. And so there really is an economy of scale if you're going to buy, shopping centers in, let's say, the 6 to 10 or $12 million range versus the $2 or $3 or $4 million range. But in general, you can say, hey, it's going to be a half a point on the very low end to maybe as much as a point and a half on the high end for these types of closing, and that should get you covered mostly. Yep. And then, of course, if you're charging an acquisition fee or a debt guarantee fee, that's another 1 or 2 points that you'll have. So it's important to think, hey, I'm going to get a loan for 75%. That means I need 25% equity. Okay, but then you've got 1% in closing costs that you got to account for. You have another 2 points potentially of acquisition or debt guarantee fee. And then the other thing you got to account for is operating capital.
Yeah.
Because think about it this way, guys. You're going to buy a deal. It's $7 million, and you're going to have to make your mortgage payment. You're going to collect the rent. You can't put your mortgage payment at risk because several of your tenants didn't pay on time. Mm-hmm. So you have to have enough working capital in your checking account to withstand the ebb and flow of those collections. Can we give them a ballpark of what we think that is? I have a number in mind, but I'd like to see what you guys think.
$250,000. I mean, depending on the deal, I really like cash when it comes to these retail deals because our deductibles on insurance are hundreds of thousands of dollars, tenant improvements, leasing commissions, potholes, lawsuits.
Depends on how much vacancy you have.
Mortgage.
You've got to pay a lot more if you've got a lot of vacancy you're going to fill up.
That being said, if you get like a $2 million deal, you get a couple tenants, you could be 50, 100 grand.
Yeah. Yeah. I would say probably a rule of thumb for me is 2 points. If we're just talking about working capital, that does not include some of the stuff Braden mentioned. If you have some CapEx projects, or if you want to have a little insurance, if you lose tenant to cover their rent, or when you need to put a new tenant in, tenant improvement dollars can be very expensive. So can leasing commissions. And I was having the conversation with my friend earlier today, is you've got to overraise because things are going to go wrong. And as soon as something goes wrong, you don't want to embarrass yourself and say, hey, I don't have any money. I need to do a capital call. And I need to go back with hat in hand to the investors and say, hey, I need more money. They don't like it. The red flag in their brain is going to go up. Okay, there's risk here. What is this? They don't know what they're doing. And so you want to definitely avoid that. And so, I would say closer to your $250,000, that would be 5% of this smaller shopping center deal. That's more in line with what you should have.
It's just Murphy's Law, man. Bad shit's gonna happen. You need to be prepared. And it's a big building. Other people are depending on you. You have tenants, you have investors, you've got a lender. Your reputation is at risk. You can't go BK on one of these deals and live to tell the tale again. Like it's very, 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 very hard to get over that. And so you just can't risk it.
Between Criterion and Precision Equity, I probably have currently 50 deals, active deals. And to my knowledge, we've never done a capital call, never lost $1 of investor money. But the reason that is partly is because we have had excess cash when things have gone wrong to cover us. And so, this is a good rule of thumb for closing costs, operating capital, CapEx in addition. But, make sure that you're raising, like if it's if you're getting a $75 million or 75% loan, I would say plan on having up to 35% of equity, 25% for the down payment, and between 5 and 10% for miscellaneous closing costs, fees and such.
Yep. Yeah, working capital, deferred maintenance.
Yep.
Totally.
So anyway, I hope that helps you guys as you guys look to do your first deal. Once again, if you have questions, call us. We'd love to help you.
Yeah, we'll throw one of these fees in the closing statement. It'll be the Joel review fee, $5,000.
Yeah. Well, let me look at that appraisal there. Matches the purchase price.
Okay, we'll see you guys next week.
All right.